Alright guys, hello, welcome back. So from the previous videos, I walked you guys through the ratios. Following this last videos, I creating this agenda that I'm going to cover in this video and I hope it's be helpful. I'm going to run some examples in Excel just so you guys have a better idea of what I'm doing. So first, I'm gonna talk how do you find the ratios and which ratio should you focus on in each financial statement. So last time, you guys kind of input data into your Excel sheet, and you guys should have something around like income statement, balance sheet, a cash flow statement, and um, and so I'll show you guys what we should focus on. So when it's come to when it's come to ratios, I would say that we have four different types of ratios, right? We have liquidity ratio, we have leverage ratios, activity ratios, and profitability ratios. So let's just break it down very simple. First, I'm talking about profitability ratios. Uh, it is measure how the company make revenues, right? And so I would say all of these you are gonna find under the income um, statement, and we're gonna work through that. What is gross margin, EBITDA margin, these margin, right? When it say margin, it just means a percentage of total, and I'm gonna review that for you guys, but just keep in mind that margins. All right. Um, next talking about liquidity ratios. When we talk about liquidity ratios, they are we are interested in to see um, is our current asset going to cover our current liabilities. So current any thing that is called current, it means that is due in 1 year. So we are interested in seeing if this company's asset going to cover its liability in a short run, right? And here is the ratios that going to do the trick. And for instance, quick ratios, right? For some of the folks, if you don't know how to find the equation, so let's say quick ratio, how do you find it? Um, I would recommend you would go to Google, right? You search how to compute quick short of ratios, and okay, I know a problem why this doesn't work. Okay, how to find quick ratio. All right, so okay, quick ratios. Um, it's gonna be equal to cash plus account receivable. Or all right, I don't like this. Let me call ChatGPT. All right, how to find quick ratio? Give me formula. I usually would just use ChatGPT, right? So quick ratio equal to current asset minus inventories and divide by current liabilities. Keep that in mind. I'm going to show you in an example later on. But anything to relate to liquidity ratios, we would only find these data in balance sheet. Um, all these yellow highlight that I do is the one that I recommend we compute and use. All right, let's talk next on activity ratios. Um, when it's come to activity ratios, um, we are interested in seeing how the company perform. And what I'm so it's activity, right? So let's say inventory. We want to see how long does it take for us to clear our inventories. So another term to say is how long is that inventory is gonna stay in the storage, right? So ultimately, if you see a trend of day inventory going up, then that much means not very good thing, right? And how do you compute that? Once again, you could go to ChatGPT, or if you remember, I have a short-term financial ratios formula sheet provided. I'm gonna quickly go over it. So let's say day inventory, right? So you take inventory divided by average daily cost of goods sold. And what is daily average cost of goods sold? Let me see. So it just means that you're gonna take cost of goods sold of that year, divide by 365, right? And that's how you find the day's inventories. The same with day account receivable, which means day AR, account receivable. So, but to give you an idea, when we're talking about activity ratios, it's gonna be you're gonna find the data to compute this by going to both the income statement and the balance sheet to find the data to compute these, right? What do I mean by that? Reference back. So inventory, we know that inventory is from the balance sheet under the current asset. The cost of goods sold, if you remember, is under the income statement, right? So this requires some sort of like going through the balance sheet to find the inventory divided by the cost of goods sold in the income statement, right? But remember, average daily cost of goods sold mean that you take the cost of goods sold divided by 365. All right. Coming up next is the leverage ratios. When it's come to leverage ratio, these are the most important for this case study. So keep in mind, when we talk about total funded debt divided by EBITDA, it's and the interest coverage ratios. Remember, a heads up is that for this one, you also need an income statement and the balance sheet. And the balance sheet to find it, right? So what is the formula for it? So total funded debt divided by EBITDA. So that is straightforward. You just find the debt in the balance sheet and then divided by EBITDA in the income statement. For interest coverage ratios, the equation is gonna be, let me double check. It's gonna be this one. It's gonna be EBIT divided by interest expense. So don't worry, just keep in mind that I'm gonna show you a few things. All right, moving forward, keep in mind these are the different ratios and where you're gonna find it on your financial ratios. Let me see which one should people focus on. All right, so I'm gonna demonstrate to you guys how, let's say, we're talking first about the profitability ratios, where you can find it, right? So you guys remember the concept of percentage total. For this one, I'm not gonna care about these. I'm not. Okay, that idea. All right, just don't care about these when I just gonna talk about the percentage total of 2024 only. So this column only. Right? So when we talk about the percentage total, which means that we're gonna take every item of this and we divide it by what? We divide it by the revenue. And the percentage total, aka it's also mean the margin, right? So when we talk about profit margin, we're talking about the the one that below here. So let's compute it. So I know that I'm gonna have to take everything and divide it by the revenue, so that I put F4 on this on the D2 here, just so it's fixed. And I'm gonna drag it down and change it to percentage. Don't mind the negative percentage, just focus on the number itself. But you could see up here, the revenue is because we divide it by itself, so it's 100%. All right, so there's a bunch of numbers. Which one should you focus on? Keep in mind, this line you see gross margin. Going back to this, do you see gross margin right here? So that means that this is the gross margin. The gross margin. So basically just the gross margin. So I'm gonna highlight that. And then what else? You guys see net income margin. So you guys would go to net income down here, and then that is the net income margin. Right there. This one. This number right here is the gross margin. this number and this number right here are calling margin, right? All right, and I would say in this case they want you to find kind of like a pattern over time. So not only that you do it percentage total and seeing this yellow numbers for 2024, you also want to do for other years as well. So the focus here is you don't have to focus on all these numbers when you're finding the profitability ratios, but just focusing on the one that has set net income, gross margin, because that is important. I'm gonna show you this, and I think it's gonna impress you guys. So you guys see the gross margin is after we subtract the revenue from the cost of goods sold, right? Let's do the same thing for 2023. Percentage total 2023. So F4. All right, drag it down. Percentage. Go. All right. So you guys see right here. You guys see that the gross margin is growing, right? Which means that in 2024 you retaining more revenue after you subtract your cost of providing your services, your products, right? So it's a better thing. It's a good thing, right? So maybe that's how you. Maybe that is a key strength of this company. This is might be something that you're looking for when you want to lend to them. But you see at the end right here, the net income. Ultimately, that is what you're gonna have at the end of everything is paying off, and you see it's increasing over time. So it's painting a pretty good picture for this company is that it's also growing, right? So that's something that you be interested. All right. So next, okay. So when it's come to EBITDA margin, so many of y'all don't find it difficult to find the EBITDA margins, and to be frank, it's gonna be hard. Personally, myself, I find it hard to do so as well. So something I do is that we could use the website that I share on our GroupMe, and let's go to that website real quick. All right. So when you go to the website, a little bit lagging. Give me a moment. All right, when you go to the website, in the under income statement, you guys see if you scroll down right here, it's give you the EBITDA for 2024, 23, 22, 21, 20, right? So these are the EBITDA. So what you can do is that at the end, you could add it. You could add it down below here across, right? But just keep in mind that you know what is EBITDA means, just so when in your presentation you kind of be knowing what you are talking about. So right here, if you hover over, it gives you definitions of what is EBITDA. So just keep that in mind. So one other trick I want to show is right here, EBITDA margin, right? So you could find the percentage of total there. So remember gross margin, right? We computed those. What do we say? We say it is gross margin. You guys remember right here? Gross margin. We compute that to be 1824. You guys see in this website that that the gross margin for 2024 is also 1824. Right? 1824. So this website have some pretty good data that you could reference. All right. Move to next one when it's come to the balance sheet. Let me show onto the balance sheet. Something we're looking at is quick ratios, current ratios, and working capital. Right. So working capital is not a ratio, but something that we could find on the balance sheet. Let's start with working capital. So working capital is just mean you subtracting the current asset, total current asset from the total current liability, which is this side over here. So very basically, you're just gonna take these number, subtracting from these number, and if it's a positive number, you analyze why it is positive, and if it's a negative number, then you analyze why that is. Coming up next is quick ratios, right? When we're talking about quick ratios, we only take into account the cash account receivable. I would say in this case, we could take contract account as well, but we don't take inventory into account. So we're gonna combine these number together. We can do that real quick. Sum of these number you could combine, and you will divide it by the current liability that we have for 2022. All right, so you see this shouldn't be in dollar sign, but so you see it's a 1.85, so which means that we have, but I leave the interpretation for you guys, right? But it just means that we have more cash than liability. Well, we have more asset than liabilities. And remember, you want to do it across to see the trend of your ratios, whether it's increasing or decreasing, right? All right, coming up next is we're talking about, okay, reference back. You could also go to the balance sheet, and if you go to the ratios section of the website, you will see that you could also find the current ratios, right? The quick ratios. But just keep in mind that you kind of know how to find those by computing those. But if you create a numbers, you compute a numbers, and it's not matched with the website, just don't be worried just yet. If as long as you use the same number across of all of your analysis, I think it's okay. Um, but personally, I would use the website. Um, but personally, I would use the website ratio just so um, it's more neat. Um, it's yeah, and it's somewhat a little bit easier for me, but I also want to understand how we could find those ratios. Okay, but not all ratios is in here, but pretty much all the important one is in here. So let's talk about the debt divide the leverage ratio, right? Total debt divided by EBITDA. So once again, I think this number, the total debt, is gonna be difficult for some of y'all to find it, but it's gonna be on the balance sheet, right? Um, However, in this case, I would recommend that we also go back to the website, go to balance sheet, scroll down for you to find the total liability. Um, do you see total debt? I apologize. 1 second. Total debt right here. So this is the debt over year, right? Maybe you could create some chart showing that your total debt increase or decrease over time. And EBITDA, like I said, is in the income statement, right? So you could take the two EBITDA. You could take that divide by EBITDA. That's how you find the leverage ratios. You could even go to the ratio where they do it for you. Debt divided by EBITDA ratio. So this is the how this ratios perform over time. I would say this is one of the most important ratios. Why is it? Because let me give you back to the case study instructions. So this is the two ratio that 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 we want the companies to follow. These are the terms. These are called the covenants, which is some kind of term that we want the companies to be compliant with. So it said that the leverage ratio cannot be above 3.25, and just don't worry about the one. It's just that it cannot be greater than 3.25. And what do you see? I don't know. I see it trending down. Is it a good thing? I let it for you guys to interpret it that. But I said the debt to EBITDA ratio is one that is very important. The next one is the interest coverage ratios, and it said that it has to be greater than 3. There is an interest coverage ratios in this website, but how could you find it? If you remember when I talk about the right here, time interest earned, just the same thing as coverage ratios. Um, it is EBIT divided by interest expense, right? So you kind of know EBITDA is from income statement, right? So EBIT is probably in there. So EBIT right here, you're gonna take this number, and then you're gonna divide by what? You're gonna divide by interest expense that is also in the income statement, and that is how you find how much it is. Let me quickly show you guys. EBIT 246.27 divided by, so you guys see here, right? Divided by what? Divided by the interest expense up here, 37.92. So that is 6.5. So is it a good thing or a bad thing? It said that it has to be greater than 3, right? I'll leave it for you guys to interpret it that. Remember, you could also divide multiple year to see the trend over time. But so these two are the most important one. All right. Next, we talk about account receivable, inventory, account payable. You can find it on the balance sheet, right? Just reference back. So here is account receivable, inventory. Account payable, where is it? It's under current liability, account payable. So that's how you guys find the data. Okay, what else? So far we are covered the first item already. Next, I'm gonna talk about peer group review. All right, what is peer group review? So far you do all the ratios for your company, but you're not sure how it's performed compared to your competitors, right? So you could imagine already you kind of need the ratios for other companies, your peers, to kind of compare with you, right? So something I would do is I provided you guys also in GroupMe that these are the three companies that I think that most align with um, Oceaneering company. And so here are the name, right? HLX, FUR, FET, right? So what do I do? I'm gonna, let's say if you want to compare against this, then I would put another column. And then I'm gonna, let's say this, you guys remember, is from the income statement, right? So we talk about gross margin and then profit, and then the margin on net income margin. Okay, so HLX, keep in mind, I would go back to the website. You don't have to compute like again another Excel sheet for that company. I would say the quick way for you to do it is going to the same website, but this time hit HLX, right? So this is the company. Tons of data that you could compare. So you see there's EBITDA margin you could compare with, but gross margin, you see 16.16%, right? So that here, this section is gross margin, right? So it's 16.16. Type that in. You don't have to fill out all this, right? Because you are just want to compare some of the key ratios with each other. And the quick way is just go through this website. Okay, so what else? Net income margin, profit margin right here. So it just means that net income margin. You see 4.09. So 4.09 is the other company. So what do you think? These companies kind of perform kind of similar to each other, right? And in fact, I see our companies perform a little bit better than the other company. It just as a commercial banker, it just makes us feel like this is our company is on par with other companies. So we somewhat in a good range of things. But remember, you could also if you have time, then you should want to do other companies such as the AMS, um, and then FET, right? Remember, like I said, the most important. Don't forget to do the the leverage ratio, the funded debt by EBITDA. I think it's so important. I think it's even more important than the interest coverage ratio. But if you run out of time, focus on computing this as well. Okay. All right. So we talked about peer review. What else could I miss? Let me think. I probably have to create another sessions, another videos, just so I could cover everything. Um, but peer group review. Let me think. All right. Let me think. All right. One more thing I want to let you guys know is why do we use the balance sheet? The reason that why we use the balance sheet is so you want to see the structure of a company. What do I mean by the structure of company? So you guys remember the concept of percentage total, right? It just means that you take everything and then you make it's a percentage of the only thing. In the income statement case, the only thing is the revenue. But on the balance sheet is the total asset, and this is the total liability and equity. So let's just do it real quick. So it's gonna be this divided by that at 4. Drag it up. Okay. So very interesting here. But what do you want to focus on? I want to focus on the big item, right? So which means this one, the total, everything that said total, is important. But in this case, I would give you a heads up: is I would just focus on the total current asset and property, right? Because that is making up the current asset is making up a big chunk of their assets. And why is it important? Because these asset is very liquidate, which means you could turn it into cash pretty easily. For instance, you couldn't turn equipment very easily, right? It takes time for you to find the buyers. But these one, like inventories, you could sell it pretty easily, right? So these are quick, and this show the structure of the company. So I would imagine if there's some slide talking about the structure, how much do they have in their current asset, and why would that be a good thing or a bad thing. Um, and you could also do the same thing for the liability and equity. But for now, I said if you run out of time, I said focusing on the structure on the asset side is a good thing. But if you could do it for this one, the liability side and the equity side, it's gonna make you stand out a little bit more since you be more equipped what you're saying. Okay, when it comes to your cash flow statement, when it comes to your cash flow statement, I would say one most important thing I would looking for is the net cash provided by operating activities. Why is it important? It just means that this money is running after you paying everything for your operations. Before you pay for other things, such as like you want to buy all the equipment or you purchasing stocks or whatever you do, right? This number is just based on operation by just operating this company. How much do I have in cash, right? So banker is very important. Is looking for this slide a lot, and if you could elaborate this is gonna be a huge thing. So these number we see it going up. Is it stable? Is it trending up? Right? Stable. Those are the things that you want to looking for. Also, another thing I would want to do as well is the purchasing of property, right? Because as a company, you want to kind of like keep investing, and so this number right here will show is this company keep investing or something. So that is interesting as well. Okay, so for this videos, I keep it at that. Next, I will touch on the forecastings, stress tests. Also means sensitivity analysis, and then the collateral analysis. All right, thank you, y'all. And if you have questions, don't be afraid to reach out to me. Thanks.